Hello everyone and welcome to Confident Compounding with Corey Kramer. Today I'm going to be analyzing Adobe stock by popular demand, ticker ADBE. I have covered this one in the past, but I tweaked my methods a little bit at the beginning of this year, so we're going to go back and review it. And also the stock is sold off a lot since then. Let's just see what we are off the peak here. As always, not individual investing advice, just how I analyze stocks. We are down 56% off the highs, it looks like, probably 50% off this high. So definitely moving down quickly. While earnings, if you look at the dark green area here on the fast graph, are still moving up steadily, adjusted earnings. If we look at basic earnings, they aren't quite as good, but hopefully my fast graph, there we go. Let's try this again. But they did move up next year, or last year, I mean. So, and this is expected. I just ignore the basic earnings for projections. But last year, basic earnings grew 35% after some years of kind of stagnation when the stock price was fluctuating quite a bit. So that looks good most recently. So there are a couple questions here. One is going to be kind of what the valuation looks like. The other is going to be, you know, when to potentially buy it, under what circumstances to potentially buy it. I've been a little more bearish, I would say, on Adobe than most other of the most other software companies that have been selling off. I just think that they're pretty big, and I don't know how much they can keep growing. And now that we have competition coming from AI, even after a 50% sell-off, so they would have been about a $250 billion company, now down to $120 billion. So everything is going pretty good right now on the earnings front, and I'll run the numbers on that. I'm also not totally convinced AI is going to destroy every software company that's been selling off right now. So I'm really kind of in the middle, big picture-wise. And what I like to do then, well, what I do always for a steady earning business like Adobe's been, is to use a combination of fundamentals to make sure we're buying at a good price. But then also, if there's something clearly coming along that's going to potentially disrupt the business, to be cautious about that, to give the market a little bit more deference in terms of these types of sell-offs. I mean, it's important to point out, like at the peak here, it was at a 50 PE, so it's not like it was cheap. Basically, it just re-rated down to 20 PE, which is probably where it should have been back a couple years ago in 2022, and then had this giant bounce again, and now we're back down to like 13 PE is quite low. So we'll look at the valuation, and this one's been below, I think, my buy price. Well, I don't know. I probably had a recession buy price before, so it might not have been. But if you look at just what kind of mid-teens or low teens earnings growth and a 13 PE, that's generally like a PEG ratio of 1. That's usually a pretty good time to buy just on the surface. I'll get into the details here in a second with the time until payback method. One thing that I do like to do is go back and see how the stock performed, or the PE performed in previous downturns. So this got down below a 10 PE without even using my recession PE metric, which probably would have produced, I think the PE then was like more like 8 something. If that's under 10, then I've been using momentum as well, along with fundamentals. If it's a company, because it shows that the stock price can fall quite deeply relative to earnings, right? So we aren't even down yet to those levels that we saw during the Great Recession, which is probably understandable since we aren't in a recession. Although their industry people think they may be going into a recession for their industry, so maybe potentially, but there's a big difference between a 13-something PE and a 9. It's like 30% lower or something like that. So just because this stock has a relatively low valuation, the past has shown that it could go lower, right? But earnings, generally speaking, haven't been like super cyclical. They had kind of this reset period in the 20 teens. I don't know this for sure, but this is probably switching to a subscription model. That's what you usually see with these software companies around this same time period. I'm going to be using the last like 10 years or so for my near term kind of earnings growth estimates and stuff. And we're going to use the time until payback method. So the idea here is if you bought this business, if you bought the whole business, how long would it take you to earn back the amount that it would cost you from their earnings and future earnings growth? We want to aim for something around 10 years, around the 9-10 year time frame. That's where I would consider a buy. And we need two metrics to do that calculation. We need the earnings yield and the earnings growth. And I've used a blended method now of estimating those two things. So let's just go to the spreadsheet and I'll just talk about the numbers here. So right now the stock's trading at 293. There's not really any debt adjustment because they don't really have any net debt that I saw on the fast graph. So what I use is trailing 12-month basic earnings per share, which I have at $17.03. So that's significantly lower than the forward analyst earnings per share, which is the other metric that I use, which is $23.42. So I average those two together. So I'm assuming they earn $20.23 as their starting earnings base, basically. And I use that to calculate the earnings yield, which is the earnings over the price instead of the price over the earnings, like with the PE ratio. And that's 6.9%. So that means if you paid $100 for the business, you would earn $6.90 back per year if earnings just stayed the same forever. But I expect earnings to grow. And so now I need to have an earnings growth rate, which will increase the amount that you earn on your $100 over time. Here's where things get a little bit tricky, and I'll run some different numbers so we can kind of get a feel for what it would be valued out at different earnings growth rates. So I'm going to take the past 10 years earnings growth, which is over 20%. The quick version on Fast Graph is 22. I limit this always to 20. I limit both metrics to 20% maximum because it's really hard to grow earnings 20% for 10 years for any company, much less a company the size of Adobe. So I'm going to use 20% for the historical earnings growth, the past 10 years. And I'm going to use analyst forward earnings growth, which is right here on the fast graph, which is 12%. And I'm going to average those together. So when we do that, we get 16% earnings growth. I would say that's probably optimistic. But if we just go back 5 years, I mean, granted, this was the pandemic, but if we go back to 2019, we have 16%, then 28, 24, 10, 17, 15, 14. That's not crazy, right? If they can keep doing what they're doing with no setbacks or anything. So that's what I'm going to start with, and then I'll look at some other potential calculations. So we have our $6.90 for every $100 growing at 16% rate. I pull that first 16% forward for the first year. So instead of $6.90, I assume we earn $8 on our $100 in the first year. You get to keep that for ourselves because we own the business. Next year, $9.28. Next year, $10.77, and so on. And we want to know how many years it would take to collect $100. And it would only take 8 years. That's well below the 10-year, kind of 9-year, 10-year borderline that I use for my buy price. I think this is actually in my more detailed spreadsheet that I have on the full Confident Compounding over on Patreon. I also have weekly picks on Patreon for $25 a month. In case you're wondering I force myself to buy something every single week. So you guys know that I don't have too many buy opportunities on the YouTube channel, but they've performed well, the ones that I have had. Each week I buy something and I share it on the weekly pick. So check that out. And there's a free tier on Patreon as well. Okay, with the advertising out of the way here. So yeah, this looks good. The real question now is the momentum and the trajectory of the stock price is obviously horrible, right? You can just look at it. You don't really have to do a whole lot of math here or calculation or charting to just look at it, and it is pretty much Now there are some that are worse than this that really dive, but this has just pretty much been a steady decline the past couple of years. I would want this to turn positive, maybe kind of what you saw here in 2022 going into 2023, where you get some kind of clear momentum going to the upside, and then hopefully that can sustain itself going forward. But you also want it below the buy price. I think the good part about this here is the likely outcomes here are I end up buying this when it's really cheap. And maybe maybe they do get disrupted by AI. Maybe earnings growth falls for a year or two, right? But hopefully I'll buy it so cheap that doesn't matter. And whenever they get things, whenever they make the adjustments, hopefully that they need to make and get things growing again, I will have bought the stock when it's really very cheap. But I'm not going to buy until it looks like the stock price is bottomed. And the momentum starts to move to the upside. I use Seeking Alpha's momentum factor, but you can just use a 200-day simple moving average as a guide. The one thing I would say is maybe make sure it crosses that and stays there for like a week. Sometimes the stock prices will go up and touch that and then go slightly above and then immediately fall down. So you want to make sure that it looks like it's going to stay above that. So let's try some different earnings growth rates here and see how low, because I do think 16% is pretty high. So let's try a 12% earnings growth rate. That's what analysts think they're going to do next year. If they can maintain that for 10 years or 9 years, it's a buy. I mean, that's the time until payback is still under 10 years. We can try 10%, still a buy, 8%. Just then it gets up to 10-year time until payback. So I think if you think that they can grow earnings 8 to 9% over the next decade, this is a reasonable price to pay. It doesn't mean it's the bottom. It just means it's a reasonable price to pay from here. Now, these earnings growth rates take into account, they need to take into account down earnings years too. So if they have a couple of years where earnings fall 10 or 15 or 20%, then they really need to bounce back very strong in order to average an 8% earnings growth rate over the next decade. Okay. And that's where things can get a little tricky, but it can also provide, opportunities for investors. I think, if you get down to thinking that they're only going to average like a 6% earnings growth rate or a 7% or 5%, it's probably still too expensive. So anywhere I would say from a 10, 12, 16%, which is kind of where we're at right now, this price is reasonable to pay. It's just a question of how far could it fall. Now, one of the benefits of waiting and just deferring a little bit to the market in these sort of situations is the market can overdo things and it can allow you to get cheaper prices. That's the good, easy times when that happens. The other good thing that turns out negative is the market is actually right about selling this stock off. Earnings over the next couple years decline. And the market is just seeing it before everybody else, and the market's basically right in terms of the direction that we're headed here. So, I think in this market right now, like a 13 PE is probably like a 5% earnings growth or something like that. So the market's pretty negative, like for fair value, not for my buy prices. So the market's pretty negative on it, but we shall see what happens. So using that momentum to have patience. Well, let's put it this way. I could have bought the stock when it was 50% higher or something like that. I could have bought it when it was 300, when the basic metrics look good, and so, or not 300, but 400, when the basic metrics looked pretty good and it was down, I don't know, 35% off its highs and it seemed reasonable. Like I could have bought there, but the momentum is what kept me out of it. And it just saved me 35% drawdown so far, which could be a 50 or 60% from here. We don't know. But I do think it does look interesting. If it was a smaller company or a company I didn't think would probably have growth challenges anyway, we saw that. I forget who they tried to buy. I think they might have gone public recently too. I forget who they tried to buy a while back, but to me that showed signs that maybe they were a little worried about being able to organically maintain earnings growth. So there are some little signs around the edges, that growth is going to be more challenging potentially. So I do watch those sort of things in the back of my mind, and sometimes it just gives me more patience to kind of sit back and wait, which is what I'm going to do now. And well, honestly, it's cheap enough now that it's hard to imagine, unless earnings falter, if it bottoms, I should have plenty of time to buy it at a reasonable price. So bias is definitely toward being more patient with this one, I think. Okay, hopefully that helps put things into context, put a few numbers on it, and a few thoughts to go along with them. Let me know in the comments what you think, and I'll see everybody in the next video.